Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Crocs Inc. Annual Report. Crocs Inc. offers a wide range of casual lifestyle footwear and accessories for men, women, and kids under its two brands, Crocs and HUIDUD. The company's product line includes various types of shoes such as clogs, sandals, loafers, classics, fuzz, platforms, boots, slides, slippers, sneakers, flip-flops, and flats. In addition to footwear, Crocs also provides a variety of accessories like totes, backpacks, belt bags, socks, bag charms, cases, attachments, cartoon character products, and Touchland. These products are sold through multiple channels, including wholesalers, retail stores, e-commerce sites, third-party marketplaces, outlet stores, and kiosk/store-in-store locations. The company's diverse product offerings cater to different needs and preferences of its customers, making it a one-stop shop for casual lifestyle footwear and accessories. With its extensive range of products and distribution channels, Crocs has established itself as a leading player in the market. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any company, including Crocs Inc., can fluctuate due to various market and economic factors. One major reason for a decline in stock price is poor financial performance, such as declining sales or profits. This can be caused by internal issues like inefficient management, lack of innovation, or external factors like changes in consumer demand or increased competition. Another factor that can contribute to a drop in stock price is negative news and publicity. If the company faces scandals, product recalls, or other controversies, it can lead to a loss of investor confidence and a subsequent decline in stock value. Additionally, economic downturns or recessions can also impact a company's performance and stock price. In recent years, companies have faced increased scrutiny from investors and consumers regarding their environmental and social responsibility practices. If a company is seen as not meeting these expectations, it can lead to a loss of reputation and a decline in stock price. Furthermore, changes in global trade policies or tariffs can also impact a company's supply chain and profitability. In conclusion, the drop in Crocs Inc.'s stock price over the past year could be attributed to a combination of internal and external factors, including poor financial performance, negative news and publicity, economic downturns, and changes in consumer demand. Crocs Inc. market capitalization of $5 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Crocs Inc. holds a significant advantage in their industry. Crocs Inc. trades at a higher price-to-earnings ratio of 33 times and a higher price-to-book ratio of 3.73 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the company's financial data. Revenue growth is driven by strong brands such as Crocs, which saw an increase in revenue from $3,277,967 in 2024 to $3,325,807 in 2025. On the other hand, brand performance plays a significant role in driving revenue decline, with the HUIDUD brand experiencing a significant drop in revenue. Geographical market trends also play a crucial role in determining revenue growth or decline. The company's revenue breakdown reveals that international markets accounted for 44.1% of total revenue in 2025, indicating a growing presence in these regions. However, the overall revenue declined from $4,102,108,000 in 2024 to $4,040,647,000 in 2025, suggesting that other factors such as gross profit decline may also be contributing to this trend. The decline in gross profit from $2,410,258,000 in 2024 to $2,357,055,000 in 2025 further highlights the need for the company to address these underlying issues. By understanding the drivers of revenue growth and decline, the company can develop strategies to mitigate these trends and achieve sustainable growth. The net income and profit margins of the company underwent significant changes between 2024 and 2025. The net income decreased by a staggering 92% from $910.6 million in 2024 to $72.9 million in 2025, indicating a substantial decline in profitability. This decrease was also reflected in the operating profit margin, which dropped from 25% in 2024 to 3.7% in 2025. The reasons behind this decline are multifaceted and complex. Supply chain disruptions, inflationary pressures, increased competition, and higher labor costs all contributed to the decrease in profitability. The company also faced changes in tax laws, including a minimum tax on adjusted financial statement income under the Inflation Reduction Act of 2022. Additionally, goodwill impairment and asset impairments further reduced net income. The gross margin also decreased significantly, with the Crocs brand segment experiencing a decline of 30 basis points to 61.3% in 2025, while the HUIDUDE brand segment saw a decrease of 290 basis points to 44.8%. This indicates that the company's ability to maintain its pricing power and control costs was compromised. Overall, the combination of these factors resulted in a substantial decline in net income and profit margins, highlighting the challenges faced by the company in navigating a complex business environment. The company's financial performance indicates a significant milestone. According to the data provided on page 72, one of the key highlights is that the company is successfully generating positive operating cash flow. This achievement signifies a strong and stable financial foundation for the business. The ability to generate positive operating cash flow demonstrates the company's efficiency in managing its operations and converting profits into actual cash. This accomplishment has far-reaching implications for the company's future prospects. With a steady stream of positive operating cash flow, the company can invest in growth initiatives, pay off debts, and reward shareholders. Furthermore, this financial stability will enable the company to navigate any potential economic downturns with confidence. Overall, the generation of positive operating cash flow is a testament to the company's prudent management and strategic decision-making. The company's debt level has undergone a slight change in recent years. Initially, debt obligations increased significantly from the previous year. However, this trend was reversed as the debt level decreased from $1,390 million in 2024 to $1,262 million in 2025. This reduction is also reflected in long-term borrowings, which decreased from $1,349,339 2024 to $1,230,885 2025. In terms of interest expenses, the company has generally seen a decrease over the past few years. The interest expense decreased by $21 million, 19.2%, due to lower outstanding borrowings and interest rates. This trend continued as interest expense decreased significantly from $109,264 in 2024 to $88,287 in 2025. However, there was an increase in interest expense from -$161,351 2023 to -$88,287 2025, which may indicate some fluctuations in the company's financial situation. Overall, while there are conflicting information regarding the changes in debt level and interest expenses, it appears that the company's debt level has decreased slightly, and interest expenses have generally decreased over the past few years. The performance of Crocs and HUIDUDE brands, as well as various regions, has been analyzed based on revenue growth and income from operations. Internationally, both brands performed well with a revenue growth of plus 10.1% for Crocs and no decline mentioned for HUIDUDE. However, in the United States, Crocs saw a revenue growth of -8.6%, while HEYDUD experienced a decline of -13.3%. The Americas region also showed a negative trend, with the U.S. experiencing an 8.6% decline in revenue. On the other hand, some regions and segments performed well. Internationally, both brands had positive results, with Crocs' international income from operations being -$111,679 and HEYDUD's not mentioned. In Oceania, Australia saw a significant revenue growth of +25%. The performance of Asia and Europe is not explicitly stated in the provided summary. Management's outlook for the company is centered around its goal to become a global leader in casual footwear. This vision is driven by a focus on functionality, comfort, color, and lightweight design. The company has identified two key operating segments, the Crocs brand and the HEYDUD brand, with investments being made in talent and the direct-to-consumer (DTC) channel to drive growth. To improve profitability, management is reducing variable marketing expenses while maintaining adequate liquidity to fund operations and meet short-term and long-term obligations. However, concerns have been raised regarding the HEYDUD brand, which has resulted in impairment charges related to goodwill and intangible assets. The company's success and global economic outlook are also seen as potential factors that could impact its business and liquidity. Management is taking steps to address these challenges by investing in talent and the DTC channel, while also reducing variable marketing expenses. While there is no clear statement on long-term strategy or outlook, it appears that the company is focused on driving growth through a combination of brand investments and cost-cutting measures. The company has made significant acquisitions and divestitures in recent years. In terms of acquisitions, one notable example is the purchase of HEYDUD in 2022. This acquisition was a substantial investment for the company, with a goodwill allocation of $710 million and definite and indefinite-lived intangible assets valued at $1,780 million. The company's divestitures are less extensive, but still noteworthy. One potential area of concern is forced divestitures, which could be mandated by government action. However, no actual divestitures have been mentioned in the extracted summaries beyond this possibility. The company has engaged in share buybacks, demonstrating its commitment to returning value to shareholders. According to the extracted summaries, the company has repurchased a significant number of shares over the past 2 years. In 2025, the company bought back 6.5 million shares at a cost of $577.2 million, while in 2024, it purchased 4.3 million shares for $551.2 million. The total number of shares repurchased is substantial, with 1,287,618 shares purchased as part of this initiative. These share buybacks indicate that the company has sufficient cash reserves to invest in its own stock, which can be a positive signal for investors. The company faces significant concerns regarding inventory buildup and supply chain disruptions. One of the primary risks is excess inventory levels in the marketplace, which may require price reduction to clear out stock, page 12. Additionally, global industry-wide logistics challenges, including port congestion and worker shortages, have negatively impacted the company's operations, page 14. Supply chain disruptions could interrupt product manufacturing and global logistics due to various factors such as natural disasters, pandemics, geopolitical tensions, or other events, pages 15-16. The company also relies on third-party manufacturers, which poses a risk of supply chain disruption if their capacity is not available when needed, page 17. Furthermore, the company's reliance on elastomer resins and strained relationships with customers due to product modifications could lead to delayed shipments and damage to reputation, pages 18-19. Disruptions in financial markets may also affect the availability, terms, and cost of capital, page 20. The ongoing wars between Israel and Hamas, Russia and Ukraine have affected the global economy, and other companies' attempts to shift suppliers could result in shortages, delays, and slash or price increases that could disrupt the company's supply chain or cause its suppliers to renegotiate existing arrangements, pages 21-22. That concludes the financial summary for Crocs Inc. Feel free to comment below, and I will be happy to answer them when possible.